SOFI stock fell nearly 15% in the past week before eventually recovering. Now, during this period of time, we have seen analysts from all around re-rate the company. Bank of America actually downgraded SOFI stock during this period of time, and we have seen analysts from Morgan Stanley actually raise their price targets of SOFI from $7.50 all the way up to $13 and still remain underweight on the company. Now, at the same time, we also have, our resident bear from Wedbush, David Chiaverini, still keeping his $5 price target on the stock. Now, if you ask me, I think some of these analysts are wrong in their projections, and I'm going to show you why. Now, on top of all of this, with the Federal Reserve actually reducing the number of rate cuts we expect next year, I've seen certain people express some of their concerns in the comments below, saying that they're worried that SOFI can actually drop below $8 per share. Now, if you ask me, objectively speaking, I honestly do not see SOFI dropping down to the single digits again, barring a huge recession in the US. Because in this video, I'm going to talk about how SOFI has managed to de-risk their company in a way that they have never managed to do so before. Now, I cannot totally rule out the possibility of a recession in 2025, but what I can do, however, is to focus on how the loan platform business actually changes the business dynamics for SOFI, how it's going to change the outlook for their earnings per share in 2025 and 2026, and what that is going to do, it's going to force the analysts to revise some of their projections around the company, and because of that, it can potentially create an even greater upwards momentum for the stock. But as always, potential is a dangerous word, so let's dive in. Well, first and foremost, a very blessed and Merry Christmas to each and every one of you watching this video on Boxing Day. I'm wishing you and your families all the love and joy in the world. Thank you for your love and support, for subscribing to this channel, and I promise to provide even more value going into 2025 as I continue to, figure out this whole YouTube thing. Now, one of the things I actually would like to do is actually to start live streaming. Now, I have a couple of ideas in mind about what to do and the directions to take the live stream. And actually, the initial plan was to start the first live stream on SOFI's fourth quarter earnings. However, I think that is going to be on the 29th of January or so. And if that is the case, it's actually right on the first day of the Chinese New Year. And because of that, I'm not sure if I'm able to get away. But you can hold me accountable to that and ask me and chase me in the comments. But I will start latest by the first week of February. So if you have anything in particular that you would like me to cover on these live stream, feel free to let me know down below. Of course, I cannot get to everybody's request, but I would love to hear your input and as I put this together. So thank you for your time, and back to the video. Now, you see, the thing about the loan platform business is that if you take management's guidance and you do some back of the napkin math, what you actually realize is that this new business segment can actually generate SOFI anywhere north of $200 million every year. Now, if you take a deeper look at the math that I did in the last couple of videos, I think there are some assumptions that I used previously, which I want to make some changes to and see how this actually plays out and affects SOFI's EPS in 2025 and 2026, because I believe this is where most analysts are wrong and where we can actually find the most alpha. But before that, I think it's important for us to understand why SOFI actually needs the loan platform business, and I basically break it down into 2 points, which is capital constraints and member growth. Now, one of the main bear arguments against SOFI previously had been, capital constraints. Now, I think we saw that happen, especially towards the end of 2023 last year. And basically, bears argue that in order for SOFI to continue growing its pace of lending, it needs to continue increasing this thing called the risk-based capital, which can be found in their 10Q. So this is basically just a fancy term to describe how they actually measure the minimum amount of capital a bank or financial institution actually needs to sustain their operation and to continue lending. Now, this is basically calculated as a percentage of the overall dollar that is lent out, and this percentage is called the capital ratio. So if you have a capital ratio of 15%, that means that for every $100 that you have lent out, you have $15 worth of risk-based capital. Now, I'll define the term a little bit more clearly, risk-based capital, later on as we see how it affects SOFI's business, because I know this can be a little bit confusing. But like I said, this is something you can find in their 10Q over here. This is from their most recent quarter, and you can see that this is where it indicates the regulatory minimum of 10.5%. And as of the most recent quarter, SOFI is around 16.3%. But the argument here basically has been that SOFI's growth has been driven by an increase in interest income. Now, if you take a look at this graph with me, you can actually see the breakdown of SOFI's revenue. And in the first quarter of 2022, the interest income only made up 37% of overall lending revenue. Now, today, we have seen the first quarter that that number has somewhat inflected downwards, but even then it is still at 79%. So the interest income is basically generated from loans that are held on SOFI's balance sheet, and that is dependent on the capital ratio. And so at that point in time, the thought process behind this was that SOFI's revenue growth has been driven by an increase in interest income, and interest income will increase with SOFI's ability to originate more loans. But as they are reaching the regulatory minimum of 10.5%, SOFI will be forced to slow down lending. Because if you take a look at this 10Q over here, this was the 10Q, I think in the third quarter of 2023, September of 2023, you can see over here that the capital ratio was down at 14.5%. So there was limited room for SOFI to grow, and the bears basically argue that either they are forced to slow down the rate of lending, which actually eventually will affect the growth rate of their revenue, or they can actually increase their risk-based capital. Now, it is important for us to note at this point that risk-based capital does not refer to customer deposits, because risk-based capital by definition have to be able to absorb losses from the business without interrupting the bank's operation. Now, if you take a look at their 10Q, you actually realize that this total risk-based capital that we have been talking about is actually made up of two different capitals, Tier 1 capital and Tier 2 capital. Now, the SEC has very kindly defined for us what makes up Tier 1 capital and Tier 2 capital, but I'm not going to dive into the technicalities today. Basically, what you just need to understand is that these different tiers refer to different asset classes. But in general, Tier 1 refers to things like common equity and retained earnings and so on and so forth. So what that actually means is that for SOFI to increase its risk-based capital, they would either have to dilute shareholders, right, take on debt, or increase their retained earnings by becoming net profitable, which is why it was important for SOFI to actually reach profitability this year, so that it basically eases their burden on the capital ratio. Now, the thing is that these bearish analysts basically discounted SOFI's ability to turn profitable and expected SOFI to eventually have to dilute shareholders or take on more debt in order to continue funding growth, both of which are unsustainable methods. But we now know all of these analysts were wrong, because SOFI turned profitable at the fourth quarter of 2023. Now, secondly, I think the interesting thing about SOFI over here is that over the last couple of years, they have chosen to grow their revenue through their loan book by increasing interest income. Now, of course, I think definitely part of it is due to the macro environment that they find themselves in. People are not as keen to buy loans, so they just have to hold the loans on their balance sheet. However, on the other hand, you can also say it was by choice, because actually the real driver of their revenue growth, even during this period when they were increasing their interest income, was not actually due to the amount of capital that they have, but how fast that their members were growing. So I'm going to show you some numbers, show you some graph to actually take you through this whole thought process. Now, if you take a look at this first graph over here, this red line basically shows you the revenue generated per SOFI member, and you can see that this has been on a declining trend. Now, I think that is to be expected as SOFI grows its number of members. I think I've covered this in a few previous videos before. The second graph is actually new. The amount of personal loan originations per member has been range bound between the $400 to $600 range over the last 12 to 15 quarters. In fact, basically this is all the way back since the first quarter of 2021. However, during this period of time, you can actually see from this third graph over here, the green color bars actually show you SOFI's revenue. Their revenue has been growing at a 40 to 50% CAGR. So if you take 2021 all the way to the end of 2023, they have been growing at a 43% CAGR, and then I think that number fluctuates a little bit if you consider 2024's number. And from this, you can actually see SOFI's revenue growth over the last couple of quarters is actually much more closely tied to its pace of member growth rather than its access to capital. Now, even then, member growth itself does pose a problem for SOFI, so I'm not actually saying that there is no problem. Now, this is something that I've previously mentioned in another video. I'll link over here, but basically the idea of it is that if you look at the credit box and the income bracket that SOFI is working in, you can actually see that at best they have around 33 million potential members in the US to go after. Now, if you ask me, I think it's quite unlikely that they will get all 33 million members on board onto SOFI's platform as a SOFI member. And so Anthony Noto has been quoted previously as saying that, their goal is actually around 20 million members by 2027 and 2028. Now, if you pay attention to the news in the last couple of days, SOFI just announced that they reached the 10 million member mark, which means that they're actually halfway there. Now, it's been an impressive growth trend if you take a look at their member growth. In fact, over the last 5 years, in terms of member growth, they are the fastest growing fintech, which is, to me, quite impressive. Because when this whole table or this whole ranking was released by FinChat, I actually expected Nubank to be the fastest growing fintech, but it's actually surprising and quite impressive to see that SOFI has been the number one growing fintech in terms of customer growth. So their customer growth basically came in at a 61% CAGR over the last 5 years, and that means that they nearly 10x their members over the last 5 years. However, I think what that means is that, they are not expecting to do another 10x in terms of members on their platform. I think they're looking at a double in terms of members from here all the way until 2027 and 2028. And I think just by virtue of the profile of the customer that they choose to serve, there's really a limit to how many customers fall within that bracket. And so the question is, if customer growth remains a main revenue driver for SOFI, will that start to impact revenue growth going forward as customer growth starts to slow down? You can see even in my most latest quarter when I did my projections, I had a little bit of trouble projecting out SOFI's revenue because I was estimating their revenue based on the growth of member. Now, however, at that point in time, some of the assumptions I had to use in terms of the member growth rates were way too optimistic, which is why I actually couldn't, understand how they were going to hit some of their revenue numbers. Now, fast forward to today, the loan platform business actually solves some of these concerns in a few different ways, actually, directly and indirectly. Back in June of this year, at a Mizuho fireside chat, Chris Lapointe actually said that, where they stand in terms of capital ratio gives SOFI the room to grow when they choose to. Now, he actually reiterates this somewhat in the UBS fireside chat recently, where he says that the overall outlook on scaling the balance sheet remains unchanged, which means they're taking a more conservative approach. But he definitely spoke about the possibility of scaling student loans and home loans. So basically, I don't expect SOFI to be overly aggressive going forward. I expect this capital ratio number to stay within the 15 to 16% range. Now, keeping capital ratios in this range actually also gives SOFI a buffer in case we do see a recession. And the loan platform business allows them to bring in another source of revenue without having to take on extra risk on their balance sheet, because they don't originate these loans on the loan platform business unless they already have a contract with a partner, and the contracts that are signed with these partners do not include any financing or loss sharing agreements. And so that is very important for SOFI to de-risk its business. But that itself is not enough, because like I said, one of the reasons why SOFI has often been priced as a bank, because it is seen by the market as being overly reliant on interest income. Now, what the loan platform business does, of course, yes, it does bring an additional source of non-interest income, but I want to be very, very specific here in terms of how they categorize this revenue. It's actually just a servicing fee from the loan platform business that is categorized under lending. Now, that number is actually quite small, so the impact here in terms of increasing its non-interest income perhaps is not as significant. I think how indirectly this new business segment helps them is basically what it does is it signals demands for loans. And this was actually reflected in the third quarter earnings, where SOFI actually sold over 375 million in whole loan sales at a 5.9% gain on sale margin. Now, I think I've spoken previously in another video about how this whole gain on sale margin works and why it's beneficial for SOFI. And the basic idea here is that the faster that they can cycle through the loan book, the less dependent they become on capital in order to grow their revenue. Because this gain on sale margin is actually recorded in the non-interest income segment under lending. If you take a look at the results over here, which I was pointing out earlier on, back in 2022, the total non-interest income made up 62% of overall lending revenue. Today, despite the inflection downward, that stands only at around a 20%. And so as the non-interest income continues to increase, people will view it less less and less like a lender, and the multiple that is being applied to their earnings will eventually increase as well. Now, I think the only asterisk here, which is something that we need to keep an eye on, is whether or not the loan platform business is cannibalistic of their whole loan sales business. And so what that means is that, whether or not people will choose to go through their loan platform business and originate through that method rather than just buy the loans off their balance sheet. Now, at the moment, of course, management has told us that that isn't the case, but in all honesty, right, what were you expecting management to say? They have to tell us that it's not cannibalistic. It is just something as investors we need to pay attention to and hold the management accountable in this aspect. So Anthony Noto told us in the third quarter earnings that many of the partners that they see are new incremental partners, means they are not previously whole loan sale partners, which is actually good to hear. But like I said, we need to keep track of this moving forward. But I think one important point to take note of over here is that the non-interest income did not just increase in the lending segment, it also increased in their financial services segment because of the loan platform business. They actually told us that the non-interest income in the financial services segment grew 235% to 84 million in the most recent quarter. So that is basically an annualized amount of 340 million in annualized revenue, and the key growth driver here has been their loan platform business as well. And so we have seen how the loan platform business has actually addressed some of the issues around SOFI's capital ratio, and at the same time their need to increase their non-interest income. Now, on top of all of this, the loan platform business actually also serves as a solution to SOFI's potentially slowing member growth beyond 2026. Now, what the loan platform business actually does is that it increases the revenue generated per product. Now, if you've been following this channel, you know that revenue per product is something that I like to track when it comes to SOFI's valuation. I'll bring you through that whole process a bit later on, but let's just talk about this first. Now, the revenue per product in the lending and financial services segment in the most recent quarter came in at $81. That is up 52% from over a year ago, and this is down largely to the revenue that is being brought in by the loan platform business. And what that means is that even if the products per member stays the same, because SOFI is continuing to scale the number of members on their platform, they're still able to grow revenue through better monetization of their products. But that is not all they said. The exact words in the third quarter earnings was this. They said that we believe there remains substantial upside in both product growth and monetization. And so what this means is that we can expect one of two things: either product expansion across their current member base, or new members coming onto their platform taking on all these new products, both of which will drive up product growth. And at the same time, they're also signaling their intent to ramp up monetization of their different products and services. Now, personally, if you ask me, I don't think a slowdown in member growth is imminent. Like I said earlier on, this is something that I would consider to be a problem beyond 2026 as they get closer to their 20 million mark. But at least for now, we have a clearer idea of how they plan to continue driving revenue even as member growth starts to slow down as they begin to capture more and more of the market. So if you remember, like I've said in previous video, the equation that we use to think about SOFI's business is quite simple. Now, we take the member growth that SOFI has, multiplied by the products per member, and that gives us the total number of products on SOFI's platform. And so from here, if you take the revenue per product, you multiply this by the total number of products, what you end up getting is the overall revenue. And so from this, we can actually see, as long as we can continue to drive up the revenue per product, SOFI can continue growing revenues at a very healthy clip, even as member growth starts to slow down. And that is exactly what the loan platform business helps them to do. It gives SOFI the ability to continue growing their overall revenue at a very healthy clip through better monetization, and at the same time this also increases the LTV of a SOFI member. Now, beyond that, when you talk about the loan platform business, what it actually allows SOFI to do is to continue serving a group of customers that they would have previously declined. Now, if you take a look at some of the statistics that SOFI has been talking about, you actually realize that they declined somewhere between 70 to 80% of all personal loan applicants. And so this is a way for them to monetize some of the customers that they have previously rejected. Now, if you take a look at how they actually describe this business, this loan platform business basically allows a person to take on a loan through the SOFI platform. However, this loan is being held on another person's balance sheet. Now, at the same time, this person that has just taken out a loan through SOFI's platform, through their loan platform business, is onboarded as a SOFI member, and they also gain access to all of SOFI's products and services while the loan is being held on someone else's behalf. So on one level, like I said, this basically helps SOFI serve members from a different credit box without having to take on additional balance sheet risk. Now, at the same time, this actually expands their total addressable member market beyond the 33 million members that we were referring to earlier. And so if you think about the bigger picture over here, as this person continues to work and pay off the loan that has been originated through the loan platform business held on someone else's behalf, their credit score will eventually start to improve, and over time they may eventually qualify for a SOFI loan. And what this means is that SOFI now has a way to cross-sell to an existing customer base and expand their product adoption across their member base at a lower customer acquisition cost and with lower risk, because they already have the data as they track how this person manages their payments and manages their debt over the last couple of years as they paid off their initial loan that was originated through the loan platform business. And now SOFI is able to underwrite better loans for this person if they want to take on a loan through SOFI's platform. Now, and to me personally, when I look at their loan platform business, I actually see this little, I would say, a cheat code that nobody has really mentioned before. Now, the loan platform business, it is a capital light, fee-based revenue and all that. It has incredibly high margins. Now, at the end of the day, what that means for SOFI, it means that, that will eventually result in a higher net income. Now, if you remember earlier on in the video when we were talking about the capital ratio and the need for them to maintain that at a healthy level, one of the ways to continue maintaining their capital ratio at a healthy level is to increase their overall risk-based asset. And one of the ways to do so is to increase their retained earnings. Now, that is directly correlated to their net income, and this will actually help them to do just that. So to me, what that means is that over a long enough period of time, this just becomes a win-win situation for SOFI. Now, you see, in a low rate environment, as long as they continue to sell their loans, as long as they continue to operate their loan platform business and originate loans on behalf of others while collecting their fee-based revenue, that would actually mean an increasing net margins for them. And that will actually in turn increase their overall risk-based capital. So that, if we find ourselves, in a high rate environment for a longer period of time, even if moving forward SOFI are once again forced to hold on more loans on their balance sheet, they actually do have the capacity to do so and to continue growing their interest income. And so the loan platform business is basically driving profitability higher for SOFI, and that has significantly de-risked SOFI's business. And so with all this in mind, how does it actually affect SOFI's 2025 and 2026 guidance, especially when it comes to their earnings per share? Now, the thing is, you see, one of the numbers that I was using to actually project out the fee for the loan platform business came from their earnings call. But what I missed was this. Now, if you take a look at the 10Q over here, you can see that this $61 million number is a number that they have referenced during the earnings call, and which is basically what I was using initially to calculate the fee from the loan platform business. But in the earnings call, they actually also mentioned that the loan platform business consists of 4 different components. Now, the 3 older components of the business basically earns them a referral fee through things like their Lantern Marketplace. And what was new was this segment over here, which they actually individually broke it down for us. And so this is the whole new segment which everybody was excited about, where what they're doing is that they're originating loans on behalf of their partners, right? So you can see in this new business segment that is a part of the loan platform business, they generated $42.4 million in loan platform fee from their new business. On top of that, then that is where you get the additional $5.5 million in servicing fee that is recognized, under the lending component. So that together makes it $48 million in revenue from a $1 billion origination instead of $61 million. So that means instead of a 6.1% fee, it is more like a 4.8% fee. So because of that, I think moving forward, what I'm going to do is I'm going to assume the loan platform business generates a fee between 4 to 5%. But for ease of calculation in this video, we're just going to stick to 4.5% fee for the loan platform business. Now, the next assumption is fairly straightforward. If you consider SOFI's lending and financial services segments even before the loan platform business, right, it has actually been growing at a fairly healthy rate. Now, I believe this is before they actually confirmed that the loan platform business was going to be a thing. They were guiding financial services revenue to be growing at 50% year over year. Now, eventually, once they confirmed the loan platform business behind the scenes and all of that, that is where they actually bumped the expectations up to 80%. And that is why all of the investors basically got confused, like, where is this money coming from? And so because of that, I dug a little bit deeper. Now, if you remove the $42 million that is allocated in the financial services segment of their revenue from the loan platform business, what you have found out is that in the third quarter of this year, financial services revenue would have come in at around $196 million. And that would actually make it a 65% year-over-year growth. And for lending revenue, because they are just basically beginning to continue to ramp up lending, we're just going to assume a 20% year-over-year growth. Now, before we go any further, I just want to explain something over here. I can't just take 65% and 25%, divide it by 2 and say that, this whole segment is growing at 42% on average. Because imagine if you have $100, you grew it by 10%, you will get $110. And if you have $20, you grew it by 100%, that will make it $40. But if you put that together, what you actually realize is that your initial capital was $120 and you actually ended up with $150, which actually only represents a 25% growth. And the reason for this is that because the impact of the higher growth rate is offset by the smaller value, which is what is happening today. We are seeing, the financial services growing at a faster clip, but because it is still a smaller segment of the business compared to its lending revenue, its impact of its growth rate is not as much as the lending revenue. So I'm just going to be using a 30% year-over-year growth in 2025 and a 25% year-over-year growth in 2026 when we consider the lending revenue and financial services revenue less of the loan platform business. Now, the second part I want to draw your attention to is this box over here. This represents the loan platform business. Now, seeing how we actually only have 1 quarter of data, I would expect the numbers here to be the most inaccurate part of the valuation. This is just the initial stages of, including this portion of their business as part of our long-term valuation. So we'll change this as we get more data in the upcoming earnings. This is just something fun for us to do, as we gear up for SOFI's earnings in just about a month's time. But if you have watched my previous video, which I will link over here, the assumption is that, SOFI will continue to reject around 70% of all personal loan applicants. This is something that they have mentioned before. And a percentage of all of these people who are rejected will be funneled into the loan platform business. Now, and since originations in the last quarter actually grew by 26% year over year, we're going to assume that going into the first quarter of 2025, they're going to be growing at 25% year over year. And thereafter, we are just basically going to keep that number constant for the whole year, right? So you can see over here, the originations in the first quarter of 2025 should be around $1.7 billion, and then we just keep that constant for the whole of 2025. And then in 2026, as they continue to scale this aspect of their business, as we get deeper into the rate cut cycles, hopefully, the demand for their loan platform business will increase, and then we'll see a 30% year-over-year growth. And so if you look at some of the checks and balances, you actually realize that some of these assumptions are more or less in line with whatever management has said during the earnings call. We are just going off that 1 quarter of earnings call. So like I said, it might be inaccurate, but that's all the info that we have at this point in time. Now, during the earnings call, one of the analysts actually was asking about how we can actually think about the loan platform business in terms of originations going forward, whether or not we should be expecting a $4 or $6 billion run rate business. Now, in part of his reply to this analyst, Anthony Nodo actually says that, we could basically exceed whatever number you have articulated, which means that, they could do more than $4 to $6 billion. So you can see over here, the 2025 loan platform business originations of $6.85 billion is basically something that is not out of the realm of possibility, something that the management has actually alluded to during the earnings call. Now, when it comes to the tech platform, the assumption here, you can see if I just click on this number, I think you can see over here, what we're expecting is a 15% year-over-year growth in 2025. And in 2026, this is going to be a 20% year-over-year growth. Now, for a more accurate comparison, right, I actually pulled out my old valuation over here. This is not the valuation where I actually counted the member growth and then account for the revenue per product and things like that. I wanted to do a more apples-to-apples comparison in terms of methodology. So this was actually a valuation that I did in one of my older videos a couple of months back before I did the member growth video. And so in that video, basically what we did was we just, slapped on some percentages over here and to basically see on a general level what kind of expectations we can have for SOFI going forward. And in that video, the financial services segment was projected to grow at 50% all the way throughout 2025 and 2026, and the lending segment to grow at 20%. So basically, we have raised similar assumptions in this current valuation. I think the main difference over here is that in the tech platform, Previously, we had it growing at around 25% year over year, and in this valuation, we have it growing between 15 to 20%. Now, of course, on top of that, in this current valuation, we also add on the loan platform business. Now, if we are to just focus on the 2026 numbers, using a 20% net income margin and a 5% dilution across 2025 and another 5% in 2026, what we end up with is an EPS of around 78 cents in 2026 versus 75 cents previously. Now, this actually tells me a couple of things. Firstly, I think maybe my current projections might still be on the more conservative side of the fence, because unless SOFI has already accounted for this when they gave their 2026 guidance last year, I actually expected a bigger difference in EPS when I actually added this number in. So this is something I'll have to pay attention to in the next earnings call as they continue to give their guidance, so I can actually adjust my valuation accordingly and adjust my own expectations accordingly. Now, bear in mind, I'm also assuming slower growth in the tech platform, and I also didn't account for the expansion of their non-interest income in lending when I assumed a 20% growth in lending for the next couple of years. So that may also be one of the factors leading to the lower EPS over here. Now, however, the second thing is that the loan platform business actually buys SOFI time to let their tech platform thesis, their AWS or fintech thesis eventually play out. Because you can actually see over here that the loan platform business actually more than offsets the slowdown in tech. So even with the reduced growth in the tech platform, the earnings per share actually still increased by 3 cents over the next 2 years. So this actually gives them time to close some of the bigger clients without, being afraid that it will actually affect their profitability. Now, but that's not all, because I think the reason why this can actually drive more upward momentum in terms of the stock price is really because the average analyst, if you see over here, despite knowing about the loan platform business, they currently still have an average EPS for SOFI in around the 47 cents range by 2026. So that tells me they actually haven't fully priced in SOFI's entire business, especially the loan platform business. And if you consider that management has been guiding between 55 and 80 cents even before any new lines of business, and I really do believe that, when they gave us that initial guidance, that was without the loan platform business, I think the analysts are then way off. And so as they adjust their expectations, they will have to start to accumulate shares of SOFI, and because of that, that might eventually push the prices of SOFI even higher, unless, of course, we get a very bad macro in the next couple of months. But on the topic of macro, I think it's important to understand how rate cuts actually affect SOFI's business, and I talk more about that in next week's video. So once again, happy holidays, and I'll see you in the next one, and more importantly, I'll see you in the new year.